Forget everything you've heard about investing. The simple path to financial freedom. You wake up one morning, and instead of stressing about bills, rent, groceries, or that dream vacation, you realize they've all been taken care of, not by your paycheck, but by your investments. Sounds too good to be true? It's not. Many people believe that investing is reserved for the wealthy or those with insider knowledge of Wall Street. But the truth is, you don't need stock-picking skills, a finance degree, or a fortune to start. With just a few $1,000s and the right index funds, you can begin your journey toward financial freedom today. In this blog, we'll break down how you can leverage index funds to create a passive income stream, how much money you actually need, and a step-by-step guide to get started. No fluff, no complex jargon, just a clear, actionable plan for building wealth. Chapter 1. Why index funds are the best investment. Ever tried picking individual stocks? If you have, you know how unpredictable and stressful it can be. Up one day, down the next. But what if you could invest without all the guesswork? That's where index funds come in. What are index funds? An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks a specific market index, like the S&P 500. Instead of putting all your money into a handful of companies, index funds spread your investment across hundreds of businesses, reducing risk and providing steadier, long-term growth. Why choose index funds? Diversification. Your money is spread across various industries, reducing risk. Low fees. Many index funds charge as little as 0.015% in fees, meaning more of your money stays invested. Consistent growth. The stock market has historically grown by about 10% annually, making index funds a reliable wealth-building tool. Low maintenance. No need to analyze stocks daily. Index funds simply track the overall market. Warren Buffett recommends it. Even one of the world's greatest investors advises people to invest in index funds rather than picking stocks. With these benefits, it's clear why index funds are the best option for building wealth. But how much do you actually need to live off them? Chapter 2. How much do you need to retire on index funds? Let's tackle the big question. How much money do you need to live off index funds? The key metric. Dividend yield. Index funds generate returns in two ways. Capital appreciation. Your shares increase in value over time. Dividends. Quarterly or annual payouts from companies in the fund. A standard S&P 500 index fund has an average dividend yield of around 1.24%. If your goal is to earn $60,000 per year from dividends alone, you would need around $5 million invested. However, high dividend index funds yield around 3 to 4%, meaning you'd only need about $1.50 to $2 million invested to generate $60,000 per year in passive income. What if you don't have millions to invest? That's where growth and compounding come into play. By reinvesting dividends and contributing consistently, even a modest amount can grow into a substantial nest egg over time. For example, if you start with $2,000 and contribute $500 per month while reinvesting dividends, you could build a six-figure portfolio in a couple of decades. It's not about having millions up front. It's about consistency and patience. Chapter 3. The power of dividends and compounding. How dividends and compounding work. Dividends are company profits distributed to shareholders. When you reinvest these dividends, you buy more shares, which then earn even more dividends. This cycle is called compounding. Example. You invest $2,000 in an index fund with a 2.5% dividend yield. Year 1. You earn $50 in dividends. Instead of withdrawing it, you reinvest it. Over 20 years, your initial investment could grow to over $155,000. Now, if you consistently invest just $90 per week, your portfolio could reach six figures much faster. Reinvesting dividends is the secret to long-term wealth building. Chapter 4. The ideal index fund portfolio. Now that we understand how index funds and compounding work, let's build the ultimate portfolio for both income and growth. A simple, yet powerful portfolio breakdown. 50% in high-dividend index funds, VYM, SPYD. These funds focus on companies that pay steady dividends, offering yields of 3 to 4%. 30% in growth-focused funds, VOO, IVV. These funds track the S&P 500, growing at around 10% annually. 20% in international index funds, VXUS. Adding global exposure protects your portfolio if the U.S. market struggles. Growth projection example. Start with $10,000. Contribute $100 per week. Over 30 years, your portfolio could grow to $1.2 million, generating $5,000 per month in passive income. Even if you start with just $2,000, sticking to a consistent plan can lead to financial independence over time. Chapter 5. What if the market crashes? Stock market downturns are inevitable, but history shows the market always recovers. Why you shouldn't panic. Losses only become real if you sell. Holding onto your investments allows them to rebound over time. Dividends keep flowing. Even in a downturn, most companies continue paying dividends. Market crashes equals buying opportunities. Lower prices mean you can buy more shares at a discount. The key is staying invested and continuing to reinvest dividends. The market has recovered from every crash in history, and long-term investors always come out ahead. Chapter 6. Action Plan. How to start investing today. Now that you understand the power of index funds, here's exactly how you can start investing today. Step 1. Choose a brokerage. Pick a reliable platform like Vanguard, Fidelity, or Schwab. Look for low fees and an easy-to-use interface. Step 2. Pick your index funds. For growth, S&P 500 ETFs like VOO or FXAIX. For income, high dividend ETFs like VYM or SPYD. For diversification, international ETFs like VXUS. Step 3. Automate your investments. Set up automatic contributions. Even investing $50 per week can grow significantly over time. Step 4. Reinvest dividends. Turn your dividends into more shares to accelerate compounding. Step 5. Stay consistent. Ignore short-term market movements. The longer you stay invested, the greater your wealth will grow. Conclusion. So, how much do you really need to live off index funds? Not as much as you might have thought. The key is starting now. You don't need Wall Street knowledge, stock-picking skills, or a huge fortune. With patience, consistency, and the right strategy, you can achieve financial freedom sooner than you think. Are you ready to take control of your financial future? Start today. Your future self will thank you.